Hello and welcome to Charting the Markets on Wednesday, the 19th of July 2023. Earlier this morning, we had UK consumer price inflation come in lower than expected at 7.9% year-on-year for June, compared to an expected 8.2% rise. And core inflation, which is really important because it eliminates a more volatile components such as food and energy costs, came in at 6.9% versus a 1.1% expected reading. So basically, with inflation coming down in the UK and finally seeming to catch up with its European counterparts, the risk of the Bank of England hiking its rates by 50 basis points at this July meeting is actually diminishing at the moment. Yes, we'll probably see some more rate hikes in order to bring inflation down even further, but it's perhaps the beginning of a trend to the downside for UK inflation that we're seeing at the moment. And on that news, the FTSE 100, as we can see here on the daily financial bet, has risen very sharply. As you can see here, we've not only taken out last Friday's high at 7,481, but we are now in the process of breaking through the April to July downtrend line and are very likely to also reach the orange line here and the red one, which is the 55-day simply moving average in orange at 7,577, and in red the 200-day simply moving average at 7,591. So these are our short-term upside targets. If we were to close above the downtrend and also above the red line, the 200-day simply moving average today, that would be very bullish indeed for the FTSE 100, and we are then likely to retest this key resistance area made up of the mid-May lows and the June highs between 7,655 and 7,688. So that would be the next upside target. And then above there, we've got the high seen back in mid-May of this year, 7,806. But basically what I'm saying is, from a technical perspective, we've broken through a 1-month downtrend line here at the dotted line. We've risen above the last reaction high, which was last Friday's high. And we are testing the longer-term downtrend, all of which is short-term bullish. In Europe, the situation is quite similar. If you look at the DAX 40, the European inflation data is going to come out today also with regards to its final numbers. So what we saw this morning in regards to the DAX 40 is a test of the July highs between 16,187 and 211 on this daily financial bet. But so far we are being capped by it. As you can see here, we marginally went higher to 16,240, but then we've slipped back below this key resistance area. Now, that doesn't mean much per se. We have to see where we close today. Ideally, we would like to close above this 1-month downtrend line, which currently can be seen around 16,130. And provided we stay above also this 1 week to 2 week uptrend line or support line here at 16,116, further upside is likely to be seen. But we would like to ideally, from a technical perspective, close above 16,211, that is to say the early July high, for us to then head back up again towards the May highs, 16,333, and then the all-time record high seen in June at 16,428. All of this will remain the case and will remain upside targets, provided we stay above the last reaction low you can see here and the orange line, which is a 55-day simply moving average between 15,996 and 15,994. So these are the levels to watch out for with regards to the short-term trend. As long as they hold, further upside is to be seen. If they were to fail though, then that could mean that we are once again topping out in this key resistance area here, just below the all-time record highs, and could then slide again. But for the time being, it looks as if further upside is in store for the DAX 40. Moving on to US markets, you can see here that the S&P 500 continues to rise on better than expected earnings. Yesterday we had some bank earnings out, most of which were quite positive. Morgan Stanley's earnings weren't so great, but BNY Mellon's and Bank of America were. And we went to a multi-month high here, I believe a 16-month high to 4,563 so far. And a rise above there would take us higher towards the high seen back in late January of 2022 at 4,595. And then you can see this peak here going back to March of 2022. That high came in at 4,637. So these are the next upside targets if we were to take out 4,563 today. Obviously, we've got some more earnings coming out today out of the US, and Tesla earnings are going to be looked at very closely, Netflix as well. And we'll have to see what those will bring to the markets and whether this current bullish momentum that we are seeing can carry us through to these levels I've just mentioned, 4,595, the late January 2022 high, and 4,637, the March high of 2022, which would be our next upside targets. Support, in case of disappointing earnings being seen, comes in at this 2-week support line here around 4,536. And then the really, really important big support levels are the June and the mid-June to late June highs between 4,458 and 4,447. Basically, as long as we stay above there, further upside should be seen with regards to the S&P 500. The US dollar has declined very sharply over the last week on weaker than expected US consumer price inflation data, and that has benefited the euro. And as you can see here, the euro has risen very sharply by over 4% in the course of last week, but then has started to struggle very slightly. You can see I need to update this to 112.75. Basically, that was the high seen a couple of days ago, and right now that is capping us short term. Actually, that was seen yesterday, excuse me. And right now we're just trading in this sideways trading range with very, very low volatility, basically indicating that the markets don't really know what to do next. And we'll have to see whether we can break above this 112.75 level, which interestingly enough, if I zoom out onto the weekly chart, more or less ties in with the 112.80, 61.8 Fibonacci retracement of the entire 2020 to 2020 to 2022 decline in euro dollar. So further upside looking likely here, and the next upside target above 112.80 would probably come in around the 113 area, and then above there we've got the 115 zone, which is a potential upside target for euro dollar. Support, support basically is today's intraday low. That came in at 111.96. If we were to fall through here, then there really isn't much support until we get down towards the April highs of 110.95. So even if we see a little bit of a retracement here, the uptrend is really strong, is likely to continue in the days and weeks ahead. Moving on to the British pound, here the picture is slightly different in that we did rally to levels last seen back in 2021, I believe. I mean, we went up to 131.42 just yesterday, and that took us back to the actually was April 2022, excuse me. That was the level here, and that mainly was where we saw the lows from December 2021. That's why I had this level in mind. Come in at 131.72. So that resistance short-term capped the cable price here at the current mid-July high at 131.42, with cable now coming off again on that weaker than expected US CPI data, the inflation data coming in at 8.7%, at 7.9%, excuse me, instead of an expected 8.2% for the month of June on a year-on-year basis, and at 6.9% versus an expected 7.1% for core inflation. And that weaker inflation data is expected to continue to be seen in the coming months, which is why the British pound is now coming off, as the Bank of England is likely to hike its rates at its next meeting by 25 basis points and no longer by 50 basis points as was expected by the market beforehand. And on that, the British pound is short-term depreciating versus the US dollar and taking us back down again towards the June highs of 128.48. So that's the next target here from a technical perspective. And then if that were to be slipped through, we would then perhaps head back down again towards the middle of this sideways trading range around 126.87. But short term, it does look as if the pound sterling has now topped out versus the US dollar, simply because the inflation rate in the United Kingdom has declined faster than what was expected by the financial markets. Now, interestingly enough, what we are seeing on dollar yen is a little different in that we have bounced off the 138 yen and 08 sen low made last week on Friday, just above or marginally above the red line here, the 200-day simply moving average 136.94 now, and are currently retesting, and this is kind of interesting from a technical perspective, the breached May to, actually it's not just the May, it's the breached March to July uptrend line here, which now, because of inverse polarity, acts as a resistance line. So we'll have to see whether we can manage to break through that resistance line and also above the orange line here, the 55-day simple moving average at 139.84. Because if we do so, then the psychological 140 yen mark could be retested, and also the May high at 140.93. So short term, it looks as if the dollar yen exchange rate here has bottomed out, and we could be heading back up again over the next few days, but probably will do so in a sort of grinding slow session after session, and not like the fast descent we saw over the last few days. The price of crude oil has risen over the last few days on worries of tighter supply. And we can see that here on the price of daily WTI, and we can see that WTI last week actually rallied to $77.17 and was then capped by the 200-day simple moving average here in red, which now comes in at $76.79, as it did back in April. And in April, we then saw a very sharp decline, take us down to $63.77. Now, this is not expected to happen this time around, because we've had 3 weeks of consecutively higher prices with regards to the price of crude oil on those OPEC plus production cuts, which now are between sort of 5 and 5.5 million barrels a day. And obviously that tighter supply has pushed the price of crude oil higher. And also over the last couple of days, promises by China that it would address its weak growth and perhaps try to stimulate its economy with several different packages over the coming weeks and months. And that has also led to the world's largest importer, China, probably wanting more oil, and therefore, because of that increased future demand, the price of oil is also rising and heading back up again towards the red line here, the 200-day simply moving average at $76.79. And then above that, we've got the $77.17 mid-July high, which needs to be taken out for us to head back up again towards the $80 psychological mark. And if that were to be exceeded as well, we would then be heading all the way back up towards the April high at $83.40. So that's a distinct possibility, provided we stay above Monday's low at $73.78. So that's the last reaction low. That's the one we need to watch for this current uptrend to remain valid. If we were to fall through there, then perhaps we could retest the late June low at high actually at $72.70. But right now, further upside does seem to be the case for the price of oil when you look at charts and also from a fundamental perspective. The gold price surprisingly rallied quite strongly despite risk-on sentiment also pushing equity markets higher. And yes, it did rise last week on the weaker dollar we saw, but with the dollar not really weakening that much more yesterday, suddenly we still saw a surprise rise in the price of gold, which has taken us to $1,984 per troy ounce intraday, so to a high which was last traded basically in mid-May of this year and marginally above the June high, $1,983. So right now we've got pretty good resistance in that zone here, and we would need to take it out for us to be heading back up again towards the psychological $2,000 mark, and then also the March high at $2,009, which is another potential upside target. With regards to support, well, basically we've got the high seen on the 14th of July, $1,963, and also the orange line, the 55-day simply moving average of $1,958, both of which should offer pretty good support. And provided we stay above the last reaction low, that is to say the $1,946 low made on Monday of this week, further upside should be seen with regards to the price of gold. And last but not least, the price of silver is also interesting, as it shot also higher and did so very rapidly, taking out the key resistance area we had in place around the $24.50 mark, and that were the mid-April lows and the June highs. Now that we have risen above those, further upside does look to be seen, does look likely actually. Yes, we're trading short term with a small volatility, but still with an upward bias, and basically provided we stay above the last reaction low, that is to say the low from Monday at $24.60, further upside could take us towards $25.50, and then above that we've got really important resistance seen at the April and also the May highs between $26.09 and 13 cents. So these are potential upside targets for the silver price in the days ahead, provided we stay above that last reaction low. If we weren't, then we have really, really good support between $24.52 and 50 cents, and provided we stay above there, also the medium-term trend remains valid. Thank you very much for watching Charting in the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.